They're emphatic. The Fed will be very resistant to a figure that moves toward 3% again if it did. So what I'm getting at is, as an investment thesis, if you think that we've attained price stability, you don't have to worry about credit and equity beta. And if you're worried that the inflation rate will go back up to above 3, don't worry too much. Stick with the adage, don't fight the Fed. It will succeed because it has every power to succeed.
Welcome to the Tao of Chao podcast, where we will try to find balance and provide a clearer path forward in this uncertain world. My guest today is Anthony Crescenzi. We recorded this at the 2024 Spark Forum at Palm Beach Breakers Hotel, where Tony was the keynote speaker, and he and I had a wide-ranging macroeconomic discussion that took place the day before the 2024 general election. And here is our conversation. Tony, his biography is much longer than I can repeat, but he's the executive vice president. He is the market strategist and portfolio manager, all very important positions at Pimco. He's member of the firm's investment committee, which is probably the most important committee at Pimco. And he is also the author of 7 books. I'm lucky if I can have 1 article published, so thank you. So I think what I have done is I put some slides together. I typically don't like to use slides because that's not a conversation, but because there's a lot of data involved, we're going to talk a bunch about where we are, where we may be going, and get Tony's professional thoughts about interest rates. We call it the rate mountain. We're on the top of the rate mountain and coming down. And any of you do hiking or skiing or what have you, you understand instinctively that coming down may be thrilling. Thrilling is because near-death experience. So coming down and going up are very different, and we'd love to sort of explore that. And we very much welcome all of you to raise your hands and ask questions. We'd love to have a dialogue with all of you as well. So without further ado, we just start with data. I mean, Tim talked about AI and a lot of things, so we start with data. And the reason I start with data is because we want to sort of share where we are, where is the United States. We hear a lot of things during the current crazy season, it used to be called, that we are doing great, we're doing bad, things are collapsing, things are doing actually a lot better. So let's just take a look at the latest numbers, and I try to highlight that in yellow. That our GDP, 2.7, 2.8, right now 2.8, expecting 2.7 by GDP now, which is something that you can go up to. GDP now is a Federal Reserve, I don't remember which Federal Reserve bank that offers this projection. 2.7 is nothing to be upset about. 2.8 is nothing to be upset about. We just had a 3. Number 2, the core CPI, which we all, apparently we don't need, if we don't eat and we don't travel, all we care about is the core CPI. And under those circumstances, core CPI is coming down. And now it's still at 3.3, but it's down from its high. PCE, which is the favorite inflation gauge of Federal Reserve, is at 2.3. So we're getting into the 2 handle. All of you know that we're all trying to get to 2. That's supposed to be the magic number, which we'll ask Tony if he knows why that magic actually existed. But let me just read off a moment, sorry. And then the PCE core, which is, again, if you don't eat and you don't travel, then PCE core is important, and the core is at 2.6, came down as well. And so we are actually in a pretty good place compared to even a year ago or even 6 months ago. More data, which I'm not going to spend too much time on, but you know, the labor economy is doing quite well. I know it's not 3.4% unemployment rate, it's at 4.1, which is pretty good. You know, old days, 5% unemployment is deemed to be what? We're in perfect environment. Now 4.1, people are getting nervous. So we need some reflection. Participation rate is 62.7, so on and so forth. Then you look at what people are thinking. The University of Michigan sentiment survey is often used, Tony, right, as you know, and just to test all of us how we are feeling. quite frankly, we are feeling pretty darn good. Consumer sentiment, 70.5 is up, and about the current economic condition is 64.9 from 63.3. So we are doing good so far. I'm going to skip that because I would just keep talking, it would get boring. So I move on. Oh, I'm going backwards. Sorry. Okay. This graph is really important, and when we're going to start talking about this a bit, is the CPI, you see it went up to 9% and then now back down to 2.4. And the core CPI went up to 6.6, now is down to 3.3. So Tony, talk a little bit about how do we get there and come down here, and then we start talking about interest rate.
Well, thanks for setting that up, Philip, and thank you to everyone for having us here, and it's a great privilege and honor. The important thing that's happened, you use the word magic number, that 2% is the magic number for inflation, because that's the Federal Reserve's target, of course. But there was a different magic number before that objective was put in place in 2012. It was Ben Bernanke, who's an advisor to Pimco, who we have the privilege of talking to in the investment committee regularly. He put in place this target of 2% in 2012. But it was before that, price stability was defined differently with words. In fact, Alan Greenspan, who I met, he was an advisor to us years ago, and I worked out of Newport Beach, California for 8 years. He would define price stability differently. He didn't have a number, and he used words that was similar to that of Paul Volcker, the legendary Fed chair.
Yes.
Both of them, you can Google it, said that price stability occurs when price changes cease to influence household and business decision-making. And Philip, in the way you just showed the GDP figures, that seems to be the case. It does seem that the Fed then has attained price stability in the old definition of it. Now, there's something important to that from an investment perspective for all of you. When you're thinking about your credit exposure, your equity exposure, so your credit and equity beta, you shouldn't fixate at all on the 2% number for reasons we'll talk about, Philip. We may not get to 2% or stay there for very long, but we could easily stay in this zone of what we like to call 2 point something, and it's 2.6 currently for the Fed's target figure. For a while, we might be 2.3, 2.4, 2.5, 2.6, just stay around there. But that's price stability. And if you need proof that there's a comfort level in the inflation story now, look away from the news, of course, but look at the performance of the stock market. It's performed exceedingly well in the past year, giant gains, even though there's been failure, you could say, to reach the 2% objective. So from here forward, I would suggest to all of you to focus away from the 2% number, to think about whether we've achieved price stability in the Greenspan-Volcker way of thinking about it, because clearly we have. And now, one final thing to say about it is, in all the data that we have internally at Pimco, in looking at how the equity market and credit markets perform, and I already alluded to this, relative to certain inflation rates, 2.5% is the magic number. I have the chart in my head. Anything above 2.5, it's not a good story. It's where the correlations are closer to 1 on everything. In 2022, you all remember, everything went down. So you don't want a figure meaningfully above 2.5. Final word is the Fed will do everything it can to keep it under 3. Ben Bernanke, in discussions we've had, along with a former Vice Chair, Rich Clarida, who works at Pimco, they're emphatic the Fed will be very resistant to a figure that moves toward 3% again if it did. So what I'm getting at is, as an investment thesis, if you think that we've attained price stability, you don't have to worry about credit and equity beta from an inflation perspective. There are other reasons to worry. And if you're worried that the inflation rate will go back up to above 3, don't worry too much. The Fed does have control, and you want to stick with the adage, don't fight the Fed. It will succeed because it has every power to succeed. But there are reasons, Philip will talk about, that the inflation rate will be a challenging story as you come down the mountain, as you say.
So it's fascinating about the dual mandate that we are so familiar with of the Federal Reserve, right? It's not just about fighting inflation, but it's also about full employment. And it is that balancing act, and they are obviously related. And this uniquely American experience. If you go to the British or anybody else, it's really about price stability. So in this case, this is when the chair pivoted from we're fighting inflation, to your point, that they are gaining extraordinary confidence. They didn't use the word extraordinary, but they're gaining more confidence in the trajectory of the inflation rate going to 2% plus, or something like that, 2.3. But they are starting to worry about employment. If you remember, I think 2 years ago, we went through 2 quarters back-to-back negative growth. And I thought back-to-back negative growth means recession. That's how I learned it. Oh no, it was a technical recession. I didn't know this term called technical recession. I didn't know what that means. I guess technically I am in recession. And the reason why it's technical recession is because employment was great. It wasn't people were not getting laid off and so on and so forth. So they are now, at least in September 18th, that happened to be my birthday, so I always remember September 18th meeting, they dropped 50 basis points. And we will spend a little time on why the 50, is it too much, too little? What are they really signaling? So being nerd on these type of things, I actually watch the entire thing and listen, and how the chair trying to struggle to balance between I am actually okay with inflation, I'm actually also okay with labor, but I am worried something like that. And hence I want to show this graph showing where is our labor economy compared to inflation. And as you can see on the left-hand side, we're still printing. Now, we just had a employment situation, is what they call it, BLS. And it was like 10,000 jobs created. It's like devastating. Well, because of the storms and so on. So I didn't put that in, just I know some of you already know, so well, how come this number doesn't look like the number we just got reported last Friday? And simply because I think it skews it, because it's a special situation, exogenous shocks. And so I use this, and we're still fairly healthy. Tony, if you disagree, please chime in. And the other is initial claims. So every Thursday, what I do, you will know what I do every Thursday, is wait for this number and then take a look how many people are on the claims. And we want to see that coming down. And sure enough, actually, it's coming down on a weekly basis, but you know, the higher number was a four-week average. So it will start coming down if indeed the weekly comes down. So Tony, maybe you can share some thoughts on how you and Pimco's thinking about employment. We can go into something nerdy about the SOM rule, but if you don't want to, it's fine. What's your thinking about that?
Well, I'm glad you see on the right the jobless claim figure. I know Bill Gross, the founder of Pimco, said to me once that it's one of his top indicators because it's a true figure from states. There's no interpolation. It's pretty exact in terms of what's happening on the ground. So that's an important figure to keep watching, and it's still pretty benign, but there has been a little bit of an uptick. But the key thing is on the left, the blue line, the downward trend. That's what Chair Powell at the Fed and his colleagues are worried about. People often wonder, did the Fed tighten enough? The move in that line tells you it has, and history tells us it has. In the early 60s, 2 historical examples I'll give you. In the early 60s, the inflation rate was benign, sort of like we've seen in our lifetimes in the last decade. Picked up, Fed raised the policy rate to 6, decided to cut rates. Like you said, on your birthday, they cut rates. But they cut rates too much and too soon. Eventually, by the late 60s, the Fed had to go back to the drawing board, push its policy rate to 9, and when the inflation rate was 6. The key there is the difference, the 3 points. So it took 3 points to solve that inflation problem, a 3-point real rate. In the late 70s, of course, inflation ran away. Paul Volcker stepped in and was very aggressive with a problem that he said was had affected an entire generation of individuals since the mid-60s. So really deeply embedded and entrenched. So where did he put the real interest rate? 5%. 5% for 4 years to handle a nasty inflation problem. So we've got 3 and a 5. The Fed, when the policy rate peaked last summer, the policy rate was 5.5. So was inflation, so it was 0. But today, 2.6 for the PC, 3 again. So that alone, the history suggests the Fed did enough and can start moving down the mountain, bringing the policy rate down. It's what gave it room. Plus that labor chart you showed indicates there must be tightness. In fact, there were job openings, final words, of 12 million people at one point. That tightening erased it. Now it's near 7. It's almost the same level of the numbers of people unemployed. And if it keeps moving, we're going to have a worsening inflation employment problem, higher unemployment, because it can feed on itself. Final word is we can reach a stall speed. If the economy slows too much, suddenly tips and you get a recession. Yeah. So they've got to think about that real interest rate and decide, is it enough? It looks like it is based on declining amount of job openings and a rising jobless rate and slower gains in payrolls. Got to get moving because it takes a long time to have impact.
So which leads us to talk a little bit about interest rate. There's a lot more to talk about. So here is a graph that I put together every quarter looking at the Fed funds rate and what they are thinking. Now, remember there's more than one person at the Fed, right? They have a whole committee. And so each regional bank president gives his or her best guess as to where everything is, and then they give their best judgment as to what is the interest rate it would be. So it's very clear this is not, the Fed will say, this is not their official view, but it's the collective at one moment in time. And you can see it's coming down. For 2024, they're expecting 4.4%, for 2025, 3.4%, and so on and so forth. The famous dot plot, which is really where I got all this stuff from, and you can see the dot plot's coming down over time. That basically means that interest rate is coming down over time. I'm going to challenge that a little bit with Tony and see what Tony thinks in a moment on how far down, how long it can be down, is it going to go back up? So that's something that I think would be very relevant to all of us because we're thinking about helping people to retire and the two silent, Tony, you and I were talking about the silent partner of taxation and inflation at retirement. So we're going to move on from this slide. This one I particularly like is after my birthday gift of 50 basis points, which we can talk about. Guess what? The yield curve, which is the interest rate throughout different maturity, has moved up, not down. The orangey red line has gone higher, not lower, after the 50 basis point drop. So Tony, $64 question, why is that?
First, my first thought when I see it is I think of it as an investor as a gift because what you showed in the previous slide is, it's important to see if we can go back to that really fast. To the right of the bars where it says longer run, that's the Fed saying it thinks that the longer run neutral policy rate is going up for reasons we'll talk about. It's now, it thinks, that in blue, that the neutral rate, where it's neither helping the economy or hurting it, is 2.9%. And so in other words, it's rising. The important thing as an investor, and if we flip back to the next chart, the market is starting to agree and thinks that the policy rate will have to be higher the rest of the decade. In fact, the forward interest rates, just suffice it to say, a price for the Fed to keep its policy rate at between 3.5% and 3.75% the rest of the decade, so, which is highly unusual. So in other words, and to tie it into the previous things we were talking about, you get, if it's true that the correlations have improved, you get the defensive properties of bonds now for free, in the sense that if at any time in the next 6 years, the Fed needs to go below the neutral rate, it thinks it's 2.9, the market thinks it's 3.5, 3.75, you win, because we would think the Fed, in the case of stress, for some stressor, we don't know what that will be, will push the policy rate below neutral. The market thinks it's 3.25, 3.75, the Fed thinks it's 2.9, but what matters for you is what the market's priced for. So you get, to me, I see it as a gift. Yeah. The defensive properties of fixed income for free, because all you need is something to happen that causes the yield to go below that. You can take the other side of that and say, maybe the neutral rate's not 2.9 as the Fed says. Maybe it's not 3.5, 3.75 as the market says. Maybe it's 4. But that's a really big supposition, and it also suggests you think the Fed could be lax and fail and have the market decide it needs a higher interest rate than that. But I would not go there, so to speak, because this institution is heavily invested in the dual mandate and will do everything it can to prevent that, and the odds are that conditions will change. So the final word on this is that rising interest rates lately probably relates to some technical factors, but some others fundamental. The 10-year went from 5% to 360 very fast. It reversed about half of that now because it's worried about the longer-term inflation and so on and so forth. But again, the Fed has a beat on it, and if inflation stays in the 2s and you can get fixed income near 6 these days for high quality, seems like a really good real interest rate to provide end investors.
But I may also suggest that interest rate movement is not solely predicated on inflation alone. There typically, when you lend money out, you worry about two things. How long is it going to be? Am I going to get paid back? So credibility about the borrower, I know, scary to think about United States credibility, may have a factor, and we'll talk about that a little bit, and so we're just building the case, which is the case here. The US budget, based on the latest GAO projection, is that anything above that red line is the additional deficit. There's no question it's going up. And I was in Hong Kong at the beginning of this year. First time I participated, when I say participate, I was in the audience of the Asian Financial Forum. About 3,000 somewhat people showed. And there were probably 6 Americans, not counting myself, so I'll be the 7th one, something like that. And because of geopolitics, and so a lot of things are not happening the way it used to. But even though there was almost no American economists or participants in the audience, it looms very large. It was all about what the US Fed is going to do. All the way in Hong Kong, 12 hours difference. And so I feel that. I feel the soft power. This is what we're talking about, the soft power of the United States, how strong we are. And what we do in this country matters globally. And they talk incessantly through the entire 2-day session about all this stuff. But this soft power is an enormous privilege, I think that was the term, that we take it for granted. You can take a US dollar and you go anywhere in the world and they will accept it gladly. So because of that, we also borrow easily too. And the way we are going is between 6 to 7% more debt per year going forward. And I may suggest that one of these days, that may, you think, affect how interest rate is going to look like. What do you think?
And it could be now, as you allude, Philip. So I wrote a book 10 years ago called Beyond the Keynesian Endpoint. This concept that there's a limit. Keynes said, you have a problem, spend. But there turned out to be limits to that in Europe. Greece reached a Keynesian endpoint, of course. It was in trouble, could not borrow in the markets anymore. There's recent examples of this idea as well, not only in the rise in US interest rates perhaps, but in the UK in 2022, Liz Truss, the Prime Minister, suggested expanding the budget deficit to pay for tax cuts. And the bond market went haywire. The 10-year gilt rose 150 basis points in a few weeks. It's extraordinary. The pound fell 15%. They reached an end point. Since 2022, and even in recent weeks, Rachel Reeves, the new Chancellor of the Exchequer, have had to adopt budgets to keep the bond market happy. Because in 2022 it was not happy. The vigilantes said, stop, no more, we can't take any more. And the UK, not being the reserve currency of the world, had no ability to expand indebtedness anymore. So it's in the midst of austerity now. Its budget deficit's going to go from 4 to 2% in just a couple of years. It's severe cutbacks in spending because it's worried about the bond market, which last week said, we don't like some of these details, and it had a bad reaction for a little while, but we think it's temporary. In fact, we would favor owning UK gilts now and some foreign bonds because of the idea that it's in the midst of austerity, unlike the US. So turning to the US, there's evidence of And an endpoint here. We saw inflation from high spending. We saw in 2023, a year ago, when the 10-year yield peaked, a Treasury tantrum. Fitch downgraded the U.S. in August of last year. Then in September, there was a battle over the debt ceiling. Then McCarthy, the House Speaker, got ousted. Bond market couldn't take it, didn't like all this stress. Yields shot up. So there's evidence of impact there. We're in a break now because there's the election coming up. But we're seeing signs of this worry about indebtedness again. I call them read my lips moments because of alluding back to George Bush, 1988. In a convention, in a speech written by Peggy Noonan, who was famous for writing speeches for Ronald Reagan, she said the biggest takeaway from the convention is when George Bush said, read my lips, no new taxes. 2 years later, he raised taxes, anathema to the Republican Party. And he did it because interest on the debt was a record high, 3.2%. And you're starting to hear talk about interest on the debt again, because we're going to reach it, that 3.2%, and $1 trillion of that spending, more than defense spending, next year. So we're going to have these moments where policymakers will have to make decisions like he did, shake hands across the aisle, and have a conversation about debt and deficits like we used to in the late 80s, if you remember, early 90s. You had to have a view as a politician about the debt and deficits to be credible. And that's coming up again. They're going to be tested. Bill Clinton, Robert Rubin as Treasury Secretary, which is instructive, by the way. Who is chosen as Treasury Secretary will matter in terms of designing policies that satisfy the bond market's worries. They solved the problems, and we had 4 years of surpluses, but I'm not so sure these days we can get people like that. But I think the conversation, final word is the generational shift, the gerontocracy, as I like to call it, is shifting. People like me, I'm a boomer, born 64, we've been in power, controlling elections since 1964, my birth year. Since then, the boomers plus the silent generation have been the biggest voting bloc until 2020, and it wasn't. Now Gen Z's creeping in, et cetera, for obvious reasons. We, boomers and silent generation, are shrinking and won't have the influence. So the Nikki Haley's who want to talk about Medicare, Medicaid, Medicare and Social Security entitlement spending, they're going to talk about it more, and you're going to see more focus on this. But so expect volatility in interest rates next year as they renegotiate the Trump 2017 tax cuts that expire. Lots of headlines. It'll take, we think, till December to fix it. So you're going to headline risk, going to watch who's in power in the important economic positions and see how this is designed. But the bond market will be sitting, waiting, maybe affecting interest rates now, saying, watch it. We're not going to let you do too much. Stop.
So take a look at the number here. This is 2024, current year. The amount of money we spend in the federal budget, which we don't have the money, $892 billion. First time in history, I believe, overspent over the defense discretionary, 849. So we are paying debt more of the budget than we spend on defense. And wait till you see 2034. Social Security represents $2.478 trillion. Thank you, Tony, for retiring by then. And Medicare, so those are two major entitlements. It's going to eat up more and more and more. But don't forget, interest is the next item, $1.7 trillion a year just to pay interest. It's a significant number. If you're interested, take a look at the GAO website, and if you can't sleep, don't read it, because after you read it, you really can't sleep. But that's something that may be of interest to all of you. The most recent IMF World Bank meeting, which just happened in Washington, D.C., where once a year on their fall meeting and spring meeting, they focus a great deal this time on not just U.S. problem, but global problem of overborrowing. And so here we go. And why this is an important slide, because it's important to our industry. So two things are happening. One is that how affordable is this? And if there's going to be a haircut, ladies and gentlemen, as you play with those tools that you use for yourself or you make available to participants, and we say, well, you're going to get this, this, and this, and this for Social Security, we better take a moment to think about, is this really true? Is there going to be a haircut? And if there's a haircut on that leg of the three-legged stool, which we don't have three-legged anymore anyways. I mean, we may have 1.5 wobbly sticks that we cannot sit on, called a stool. That's going to get even more wobbly. Number two, Tony already mentioned taxation. who's going to pay for all this, right? So we start thinking about Roth conversion. We start thinking about a lot of things that is near and dear to all of you in one way or another, either personally or professionally. And so these are all impactful as we think about the future, as we think about why is this all relevant. Sometimes sounds like blah, 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 kind of boring, but it is relevant to your lives, to our lives, and to the clients that we owe our debt of fiduciary duty to. And how we think for them, how we alert them and get out of their comfort zone. Okay, if you are not disturbed by now, I think we have more to disturb you, right, Tony? These are some of the things I wrote down. We are, of course, tariff is front and center, and I won't do the economist part, but you may, Tony, tell me a little bit about how is that helping us from, if we continue the path, regardless, we're not trying to get into politics, regardless who is in power, at least with China, tariff is more likely to continue in a more perpetual way. The whole notion of industrial policy, which I put down here also, is $2 trillion. $2 trillion from these three programs, the IRA, Inflation Reduction Act, the CHIPS Act, which we all know about, and Infrastructure and Jobs Act, is about $2 trillion. And if you add the private industry, because this is really a down payment, right? They go and give, I don't know, $300 million to Intel to build new foundries. And Intel say, thank you very much, but $300 million is not enough. So they have to come up with the other $700 million to make it $1 billion just for one thing. So there's a lot of money going to be spent doing this. So I call this the new American Renaissance. The exceptionalism of America will go on because we are going to spend so much money. But where is this money coming from? And is that inflationary? At the same time, we don't have an immigration policy. We have immigration reaction, which is very different than a policy, right? We have knee-jerk reaction. We like them, we don't like them, we kind of like them, we only like certain kind of them and not all of them, and so on and so forth. And how is that going to impact our labor force, which has something to go back to the Fed policy, and go back to the Fed policy because we're overspending of money that we don't have, which the bond vigilante may show up. I know I'm going on and on. Tony, what do you think? Where are we at with this so far in your mind? How should we dissect it?
Well, on the slides, a lot of words, but the key is that it's a lot of numbers. It's a list. There's a long list of things that are costly that probably mean the inflation rate would be more difficult to be at 2%, to stay at 2%, because all of this, the energy transition is costly. The shifting of the supply chains is costly, and these are all imperatives worldwide. Germany needs to spend more on defense for obvious reasons. Mm-hmm. Germany and its allies in Europe and our allies all need to spend more on the energy transition because they can't import energy from Russia anymore. So it's a costly thing. The rewiring of this global supply chain, it's an imperative for many companies. China plus strategies, et cetera. All of it is costly, and what it does in the end is absorb the global saving that kept interest rates down for maybe 20 years, arguably. The global saving glut, according to the World Bank, is somewhere around 25%, and it's charts on the internet, of world GDP. It's very large, but it's getting drawn down because on Philip's list, you see lots of money having to get spent in lots of things. And that means fewer dollars, yen, euros for treasuries, and they go elsewhere. So even Saudi Arabia, for example, has a 2030 plan to invest more domestically, and you see lots of projects there, then put money in, let's say, US treasuries. So you see a drawdown of the global saving glut will affect real interest rates and keep them higher. But as I said, with the forward interest rate in the high threes, instead of the market thinking that someday the policy rate will get to zero, where it was recently, means we're already pricing for this in a substantial way. And again, over a period of time, you'll get defensive properties of fixed income for free. But it's costly. Probably means a little more inflation, but the market's price for this in terms of the interest rate.
Let's add some more baggage onto that camel. Climate change, of course, significant. We just experienced it in this state, climate change. US demographics, there are some counter-cyclical, or not counter-theme facts. So we always learned, and Tony, tell me if I'm wrong, or more nuanced, let me not say wrong or right, but more nuanced view. As we get older, supposedly, we spend less, we save more, because we're worried about something that we all talk about, lifetime income. We're worried about spending too much, and we live in my favorite picture is living under a freeway bypass in a tent. So we worried about that. So aging supposed to be disinflationary or even sometimes deflationary. Labor shortage, I already talked about. That could be negative because that means rising wages, right? You have supply demand is very straightforward. That's probably the most important thing to think about. And AI tend to be an advanced technology, advanced manufacturing, all that, tend to be disinflationary as well. And then there is, because of all that, maybe there's increased productivity, which is also disinflationary. So I'm not going to ask you a question I don't think you have the answer unless you do. It's really hard to put all these together in a very complex system to say, yeah, based on this, and this, bang, that's the answer. But how should one think about these forces in a secular standpoint? Not, obviously not happening tomorrow, but it's happening. So,
well, Philip, I think you put it exactly right. That's double-edged sword. And I'll give you the double edge on one of those. For example, the third from the bottom, the retiree population tends to be disinflationary. The way I like to put it is that it can be inflationary as well. And the reason is simple. There are vast numbers of boomers retiring this decade. 1957 was the biggest birth year last century. Add 65 to that, that meant 2022 was the biggest wave of retirements we've ever seen. And it lasts till the last boomer turns 67 in my case. So the rest of the decade, massive numbers, 360,000 people per month currently turning age 65. So that means that adds to the shortage of labor. And there's another element to this, something else Steve Jobs used to say, that it's the idea of, bear with me on it, stakeholder capitalism as opposed to shareholder capitalism. In the shareholder capitalism model, Milton Friedman, 1970 essay in the New York Times, he said, the sole purpose of a company is to grow its profits. Any social responsibility is up to people, individuals. Today, companies can't say that. Go look at the Davos Manifesto from February 2020, from the forum there. It was all about stakeholder capitalism. A company has to be seen as helping the community, not damaging the climate, in fact, reducing CO2, and treating workers better, more inclusion, diversity, and sharing of income. So in the context of retiree population taking people out of the labor force, labor shortages, they have to pay them a little more. So here's the math, simple. Bernanke likes to use this equation, many economists do. The way to predict inflation is simply to take the wage number, subtract productivity, and that's your forecast. The wage number, Friday, job report, 4% year over year. Productivity is 1.5%, so you get to 2.5% inflation forecasts. And as Philip showed earlier, it's currently 2.6 for the PC, so it kind of makes sense in that context. But that 4 is stuck. It's been stuck there, which is a good thing. What I'm trying to get at is it's higher than last decade. Last decade, the wage figure tended to be 2.5, 3. Productivity 1.5. That's why we had a 1.5% inflation figure. So instead of 2.5, 3, I submit the idea that it could be 3.5, 4 from here because of the stakeholder capitalism story melded with the factors you see there. And that'll mean inflation in the mid-2s. But again, it needn't be a negative, the Fed having difficulty keeping the inflation rate down at 2. As long as we have price stability, as an investor, that's the main thing you care about because that's what will determine the performance of the economy, equities, credit, even other investments, alternatives, and housing.
Tony, would it be fair to say that we may want to celebrate that we are getting a higher interest rate that will be good for people who are on fixed income, as long as inflation is not the driver for that higher
Absolutely,
interest rate,
including
right? So there is a silver lining in every cloud. So it's what I'm trying to suggest is that whatever I'm saying, I can't say for you, but whatever I'm saying is it's not absolute, right? There is a flip side to every assumption, flip side to every dialogue, and that we need to be open-minded and think broadly rather than very narrow and say, well, this must be it. And it's seldom must be anything.
And one quick
yeah, please.
Example on that. China, February 2022, had 1.1 trillion of U.S. treasuries. February 2022 is when Russia invaded Ukraine. Then, for whatever reason, it could be coincidence, they started selling, and now they have 770 billion worth. So that, as an influence, global demand has affected interest rates too.
There's questions. Please, there's a question. Anybody has a mic? This lovely lady. I get excited when people have questions. Please, thank you so much.
You, of course.
Yes, thank you. Thank you.
Hi there, 2 questions. So what just happened with those $300 billion of treasuries that you said went down? That was the first question. And then the second question, I'm an advisor. I can't fix any of this. What is your recommendation to advisors in the 401k plan world?
Well, where'd the money go from China? Look at gold. It's widely believed that China's been a big buyer of gold. Who knows what else it's buying, but it's had to take the dollars and put them somewhere. It wanted liquidity, something that's fungible. Gold can be converted into anything. And so gold is a record high last week. It just keeps going. So they've accumulated a lot of gold, but who knows? There could be cryptos, but you don't know. You can't know for sure. But it's spread the money around, and may have used the money domestically, as we've heard. They're in the midst of fiscal stimulus. So it's probably taking the money back home to apply to its slowing economy. In terms of 401k, if I had the question right, in terms of advice, I go with what's instructive is about what to do is what not to do. One is to don't try to time the interest rate markets. It's very difficult to do. If you think interest rates are going to go back up, perhaps think about how you're scaling, but market timing is very difficult. So we would suggest avoiding that when yields look attractive relative to history, expected inflation, and expected volatility. So you want to move a little bit away from cash and have a duration, we think, average duration around 5-6 years. The 5-year point on the yield curve outperforms every other point on the yield curve when the yield curve goes from inverted to flat to steep, which we think will happen. It's the top performer. So we're favoring the 5, 6, and 7-year maturities. The 7 years is the end point by where the Fed's rate changes stop having influence. We call it neutral point on the curve. Everything else could be considered the long end. Second don't is it's about catching falling knives. So so you're worried about rising interest rates, falling bond prices lately. Okay, don't catch a falling knife. Be careful. But do catch the yields while you can. So it's instructive on scaling. So if you're nervous about moving from cash, just at least do something, because the yields seem attractive to us on a real yield basis, and do something. So think about scaling. And final don't is don't fight the Fed. It's cutting interest rates now, and typically it's up to 2 to 3 year run after the peak in the funds rate, which was a year ago. So you have another 1 to 2 years of runway, probably, to be buying fixed income. It should be in a buy mode, and believe in its success, eventual success. It has every means of keeping inflation down. To think that the inflation rate will run away again is saying the Fed will fail. It's not a place that I want to go. As an investor, it's historically made sense to just don't fight the Fed. So that's the advice, I guess. Just want to lock in the yields, and don't be afraid of equities. Don't be afraid of all these things that people try to make us worry about. Even, final word is tariffs. 2018, he said, we're worried about tariffs, or trade wars, and that sort of thing. Did you no good as an equity investor? The NASDAQ's tripled. No. So don't worry about all this stuff in the headlines. We're easily taken by them. And be optimistic that companies will figure things out. Every final word is Adam Smith, of course, said the wealth of nations is built on all of us collectively doing something for ourselves that builds the wealth of a nation. Everyone here, all of you have endeavor to do better for your clients, for yourselves, for your own lives. And that drives wealth creation. So don't get pessimistic, as Warren Buffett would say, don't bet against America, basically.
I would just quickly add to, back in the 90s and 2000s, when globalization was probably peaking, you see everything's made in China. We go to wherever store is all made in China. So a lot of money came here. because they sold here, they exported into this country, and they receive US dollars. So that dollar is kept in the United States and bought US treasuries. Guess what? It helped many of us who are homeowners or trying to buy a house at the time depress the lot of interest rates. Those days are over, finished, kaput, whatever the term you want to use. And today is, so where's the money go? Well, first of all, there's a lot less money coming in. If you take a look at a chart, which I have not here, that actually shows you the trade with China is coming down and trade with Mexico is going up. Now, there's a whole controversy about China is really moving some of their manufacturing to Mexico and so on and so forth, but let's not worry about that part. But there is a de-dollarization going on. Do not confuse that to de-reserve currency. US is still the reserve currency #1, no matter what you think about US, China, no matter what you think of China. China is not ready. They have a closed system. And because of the closed system, they are not ready, nor do they want to be the reserve currency, because it's all about control. They cannot control the flows when they are open. We don't care in that sense. We are the reserve currency. So from a reserve currency standpoint, I'm not worried at all. I don't see a substitute at all. Euro, we can spend a whole afternoon talking about the issues. Draghi wrote a scathing report for the EU about the failure of, or the things that they need to do to revive the European economy. So I'm not going to go down that path. But, so some of the money are just not coming because they are settling in renminbi instead of US dollars. So that's one reason it's not going up, and number two are all the things, well, not number two, but those are other reasons that Tony mentioned. Sorry, other questions?
Yeah, question over here. I'm reading from the New York Times a few days ago. The beginning of your presentation seemed to say the economy is really good. So this is Tamara Flamer, 27, says she hasn't noticed. What she knows is that paper plates and meat remain more expensive than they were a few years ago. Gas is up 50%, ground beef is up 50%. And the famous prognosticator, my wife said, do you believe how much we're paying for freaking watermelon now? So if everything's 50% more compared to a few years ago, what's got to happen? Either the price of goods are coming down or real wages is going to go up before you're going to get people to go, yeah, the economy feels great. I think that's why most people don't feel the way the charts are.
But you said it there. I think that the real wage number has to stay high for longer to catch up.
Yeah.
And that, as Philip is saying, on the way down the mountain on interest rates, it's tricky to do. The Federal Reserve is trying to cut the interest rate to keep the unemployment rate from rising. But if it moves too fast, like historically it has, and too much, sort of like walking a dog with a long leash, it's very difficult to get it right. And to keep that wage figure near 4. It's possible that the economy reaches a stall speed and the wage figure is suddenly 3.5 or lower, and then it's too close to the inflation rate to allow the catch-up to improve standards of living. What in the end, as Alan Greenspan would often say, and economists would, that what will boost our standard of living, will get us out of the quagmire of paying more for goods, is the productivity number, which you can't predict. We don't know whether it will get a boom or not. In the late 1990s, there was a boom, the technology shock, 1995. No one knew. Greenspan used to say about it that we don't know what the benefits of this will be, just like we say today about AI, but that there would be, and there were. And that really helped the way people lived, and we had massive productivity gains. AI, we don't know yet. The only benefit right now, but it's not a full benefit, as Philip says, double-edged sword, is it's boosting stock prices, giving us more wealth, allowing more spending, giving us more inflation today. So there's a negative side to the things that later will help solve the real disposable income problem. So hopefully there's a productivity boom coming from the AI thing. It hasn't happened yet. And that would solve it, but we're getting the flip side of it, the negative, double-edged sword of it. High equity prices, strong economy, persistently high, relatively high inflation.
I would evoke since we're in the election season, I would evoke a prior, I think Mr. Edwards, yes, last comment, that to America. I wrote about it 2 quarters ago, that the aggregate number looks really good. And most of the folks in this room, if not all of us in this room, are at that top 30%. We saw our real estate prices went up. We saw our stock market money went up. I mean, we are filing taxes for next year, and we're looking at the total amount of interest income. Haven't seen that interest income for a long time, but that only happens for people who are savers. If you don't have 2 nickels anyway, so then you wouldn't benefit. So there is to America. So I totally agree with the gentleman's point. But I think we're running out of time. I want to just show the gentleman that this chart on the right, 12-month inflation-adjusted constant dollar income increase is above inflation. So yes, there are people who are affected. We were talking about, average meal is so much more. But if you look at the wages have been increasing, in this case 1.4%, assuming these numbers are correct, reported by the government. So I will, first of all, I'm sorry that I probably spend way too much time talking and Tony didn't. But thank you for your questions, and we will hang out a little bit. And if I may just conclude by quoting the following. Sir Anthony Hopkins, which most of you know, said the following. This is his philosophy. What people say about me is none of my business. I am who I am and do what I do. I expect nothing and accept everything. We live in a world where funerals are more important than the deceased. Marriage is more important than love. Looks more important than the soul. We live in a packaging culture that despises content. And with that, I will conclude. Hopefully the packages here and the content were satisfactory to all of you. And thank you, and enjoy your entire 2 days event here. Thank you very much.
Thank you, everyone. Thank you, Philip.
Thank you so
Amazing.
much.
Awesome.
You can always find more episodes by visiting philipchow.us/podcast, or find us on your favorite podcast app. You can always leave us feedback, ask questions, or request a topic for us to discuss by sending an email to pc@philipchow.us.
Views expressed in the Chao podcast are individual opinions, and they do not represent the employers of each guest or the firm each guest is associated. Our podcasts are for educational and informational purposes only and should not be deemed or viewed as investment advice or recommendations. Please consult your personal financial advisor, investment expert, or investment fiduciary before taking any actions about your plan and investments.